Hi, hello everyone. So let's start discussion on the second topic of the credit risk management, which is a part of the risk management. So in this video, guys, we are going to discuss on the critics, credit appraisal and due diligence, where we discuss on the credit appraisal foundations, for financial analysis techniques, different kinds of techniques we look. Then we look on the ratio analysis in lending, how to do the ratio analysis, what things are included in the ratio analysis, and lastly we discuss on the risk assessment and the stress evaluation technique or the scenario analysis techniques that use in the credit appraisal due diligence. So guys, if you are interested in the risk management side, like the market risk management, credit risk management, operation risks, or the liquidity risks, so do like and subscribe my channel. I am continuously creating good content on this video, and that will help you to get the job in this domain. So let's start discussion on this today's video, that is a credit appraisal and the due diligence. So initially we are discussing on the credit appraisal foundations, where we discuss on the introduction of credit appraisal, what things are included and excluded in the credit appraisal, and how that will impact it on the NBFC and the banking industry for the credit appraisal foundation. So let's discuss on the introduction to the credit appraisal. Basically, the credit appraisal is a structure evaluation used by the lender to borrow the credit worthiness and repayment capacity and overall risk profile of that customer. So where in the credit appraisal they will check the credit worthiness of that borrower, how he will be the repayment capacity, how much the credit we should give that borrower it is, and the most important, and the repayment capacity, how they will monthly pay us the interest rate and the principal from whatever amount we give them. So they will check that all these things in that the credit appraisals, and also they will take overall risks of that customer, how much the risk they will taking while giving loan of the such customers. Then we will discuss in the in corporate and the project finance lender to judge whether the cash flow are stable, predictable, or sustainable to support the timely debt services. We will look that all these things, like a lender judgment, cash flow are stable or unstable, what we predict, that how much the cash we are going to inflow or outflow to the or cash account, so that we think they do. And then the process start with the understanding of business model or the industry contest or the competition positions, regulation, and the operational stability. So they will, understanding that what is a business model, what is the ecosystem of that business, how they generate the revenue, where they invest more, where they invest less, how they collect the funds, what are the inflow outflow of funds, what are the industry context or the size of that industry, what is the repayment capacity belongs to that industry, what is their model fit in that industry. We do the risk analysis part of in that case. And then competitive position, what are the positions, they will do the porters model, or the the seventh base model, or the short analysis, gap analysis they do. Then the competition in the industry and identify, and then the regulation, who regulate that industry, and the operational stability for that business, so they can do the credit appraisal correctly. Then the analyst validate the financial statement, assess management capability, governance, and review the historical and the project performance, how that project will perform and how the future of that project. So analyst role will come in the financial statement analysis or the the project performance, and on that basis they will provide the loan on the credit appraisal for that the borrower. So the key include the market volatility, overall cost overrun, delay, or the concentration exposure, and the leverage level, that all these things they will include. Projected cash flow are compared with debt obligation, and to test the repayment feasibility and resilience, how the repayment capacity of that the borrower, if we give the loan, so that all these things will check by the bank or the financial institutions for that borrower. And then the finding the shapes, loan structure, pricing, or the monitoring requirement and the final credit decisions, and then they will take the final decisions. So how much the loan will give, loan structuring, and then ultimately credit appraisal balance the opportunity with the fraudulent risk management to protect the asset quality and limit the default losses. So it is, and the entire process flow, the credit appraisal is the entire process flow where they take the credit worthiness and the risk profile and the judgment and the cash flow. Then the analyst role will come, he will do the assess the management risk capability and the risk indicator that check the overall cost run or what are the risks there. And then the due diligence or the background check will happen, then the funding or the credit monitoring requirement, final credit decisions, and the ultimately credit appraisal balance opportunity will happen. So it is in credit appraisal the entire process from the customer acquiring and the final loan will give that customer. So that all these things will come under the credit appraisal. So let's move on the next slide, that is a financial analysis technique. So where we do the cash flow versus profit analysis, key project finance matrix like the CFADS, DSCR, LLCR, PLCR, and the ratio analysis in the lending. So all these things we will look in the financial analysis techniques part. So let's first we discuss on the cash flow and the profit analysis. What are the cash flow and the profit analysis involved? So where we are going to discuss on the why profit differ from the cash flow as repayment capacity, what cash flow analysis will cover, and value of the projections and the complementary insights for such the projects. So let's first discuss on the why profit differ from the cash, what the things that will different from the cash flow. So profit stream may occur accounting record revenue and expense when incurred. So non-cash item depreciation, provision, accrued, and the policy choices can influence the difference the report and profit without changing the industry or the liquidity. So that's will differ from the cash flow. Then the cash flow and the repayment capacity. It is and also important. What is the cash flow and what are the repayment capacity? So they need to manage their expenses. There is the profitization is more and the expenses is less for the organization. So debt service is paid with the cash, not accounting earning. Lender really on actual cash generation to judge the sustainability and timing and advocacy of inflow versus the scheduled payment. Timely payment, repayment will happen, and the debt service ratio. Then the what cash flow analysis covers. So what are the things, what are the parts we need to cover in the cash flow analysis, where we cover the operational cash generation, working capital movements, how the working capital move, and the taxes, capex need, the financial cash flow together reveal the true liquidity and available of the debt services. So that's we will discuss on the cash flow and the cover analysis. Then the value of the projection. So forward looking cash flow incorporate assumption on prices, cost, efficiency, enabling lender to test the scenario and assess the resilience. So that will we do the value projection. And the complementary insights, profit analysis explain the performance and margin but cannot replace the cash flow evaluation. Together they support the sound well the credit decisions of that the organization. So that's the part of the cash flow versus the profit analysis. So let's discuss on move on the next slide, which is the most important slide, that will cover the key project finance matrices. That matrix is most important, guys. You need to more focus on that part if you are going to the credit risk domain. So first one is the cash flow availability of debt service. So that's we also called as a CFADS. Then second one is a LLCR, loan life coverage ratio. Then we will cover on the DSCR, debt service coverage ratio, and then PLCR, project life coverage ratio. So in the cash flow available of debt service ratio, we measure the actual cash generated after the operating expenses, taxes, working capital, and apex flow. True cash flow available and debt service, we will do that thing in the mathematical calculation we will take, and one of the examples so where we discuss in detail the cash flow available of debt service ratio, how that will work and how that will help bank to appropriately manage the finance project finance matrices in their projects. Then we will discuss on the debt service coverage ratio in detail. So in the debt service coverage ratio we will cover divide the DFADS divided by the total debt service indicate an ability to cover the debt cash flow. So DSCR is greater than 1 point means adequate repayment will happen from that organization. Then we will discuss on the loan life coverage ratios. It's and the most important ratio for the loan life coverage. So where we discuss on the NPA of the CFADS during the loan tenure divided by the outstanding debt and reflect the long-term coverage over a life of loan. So we'll discuss in that the example all these ratios and the PLCR project life coverage ratio NPA of the CFADS over the project full project life divided by the outstanding debt and show the long-term value and credit repayment questions for that ratio. We will discuss that in detail. So these are the ratio. You should understand how that ratio will work, what are the formulas of that ratio, and that will definitely help you to get the credit risk side analysis. Then we will discuss on the ratio analysis and in lending. So what are the ratio analysis in lending, what are the ratios we need to cover, and why that ratio is important, and what thing we get, what are the understanding and why that ratio is important. So that thing we will discuss and we will do the mathematicals part of that ratio. So let's the key metrics for the corporate and the project lending in the ratio analysis. So purpose and the scope. So ratio analysis genuine the financial health, liquidity, leverage, efficiency and profitability, giving the lender has a quantitative basis of credit assessment and monitoring. So that's the ratio analysis. Then the corporate lending focus, liquidity, current weak liquidity, current liquidity, leverage ratios like a debt to equity, total DBTA to EBITDA ratio, earning before interest tax and ratio is important, interest coverage and profitability ratios like ROE or ROCE indicate the repayment capacity and solvency. So then we will focus on the project finance emphasizes cash flow metrics like DSCR, LLCR, PLCR are gearing guide view and stability, sustainability and long-term project viability. Then we will discuss on the project structuring covenants, ratio informed debt tenure, amortization, reverse requirement and covenant designed to align with the risk repayment capacity. Then we will discuss on the trend and the benchmark things for the ratio analysis in the lending. Time series trade flag early districts, peer and industry comparison reveal the competitive strength and operational readiness. So that thing we discuss. Let's move on the second last slide, that is the risk assessment trace evaluation. So it is where we discuss on the sensitivity and scenario analysis and the trace testing appraisal. So let's discuss on the sensitivity and the trace analysis. So the sensitivity analysis involve one variable at a time. So sales volume, these are the variables: sales volume, pricing, operating cost, interest rate and delay. These vary to see which assumption most affect the cash flow, profitability and debt service. Highlighted critical risk derivative and identify the break even point where the viability is threatened. So we will do the sensitivity analysis. We'll do the each variable to check that variable is appropriately work or not work on the using the Python or the ML technique or the rule based technique. And then we will do the scenario analysis. So from the history or manually generated scenario, we do how that portfolio or the performance of that credit will work on that search scenario. So assess the combined shift across the multiple valuable using the base downside worst and management cases, test real resilience under the revenue, stock cost escalation, inflation, regulatory changes, market downturn by applying the realistic and adverse conditions simultaneously. Together, these tools quantify risk exposure, guide the structure, and coherent in supporting the borrowing discussion on mitigate and operational improvement. So that's we will cover in the sensitivity analysis and the scenario analysis. So these are the end of that slide, guys. If you are like content in that video and my video, so please do like and subscribe my channel, so that will motivate me to create and more and such more videos for you guys. Once again, thank you so much guys for attending this video. Thank you so much, guys.